Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. Hey, I'm a little late getting on today. I was crunching some numbers on a spreadsheet. There's a lot of information I need to share with you. And what I plan to do today is give you an example of the time value of money. And it's not the example that they probably pounded into your head. Well, if they pounded it into your head in college, because depending on what you studied, you may never have had exposure to the time value of money. The other critical problem that's out there is this stuff really isn't addressed in our high schools. It really isn't. Now, maybe you took a math class at one point where they talked about, the time value of money, but it was probably lost on you. You were probably sitting down going, man, I just got to study for this test. I just got to get through this and get on to the other side so that I can go out and play sports with my buddies after school. Yeah. So here's what I'm getting at. One of the things that our founder and CEO, Del Walmsley, says is that you need to focus on a methodology that will allow you to double your income over time and to double your investment over time. Now, those are two different approaches. See, doubling your income has to do with buying assets that create additional streams of income. And that's actually step two. See, step one is to buy assets that will provide streams of income that you don't have to go to work and obtain. And if you do it correctly, you buy an asset, you double the amount of money that you put into that asset. You take that money out of that asset. You go buy another asset, or you just sell that asset and you go buy two properties to replace the one you sold. See, that's kind of the compounding effect. So where I'm at today is probably all over the map in your mind. I get that. But I'm going to talk about what it takes to take $1 and double it. And I'm going to take a look at the stock market. I have to use historical gains in the stock market because we don't know what the future holds for the stock market. I mean, it seems to be doing okay today, right? Yeah, a year ago today, it wasn't doing so hot, though. Yeah, and a year and a month ago, it was doing very poorly. But overall, the stock market's doing pretty healthy. Let me give you some historical returns as of today. So let's say you took $24,000, and I'm using the number $24,000 specifically because I'm going to compare later on in the show what $24,000 invested in real estate will do for you. But before we get into that, we have to talk about what you're probably doing now, which is taking money and putting it into the stock market. You're maybe buying mutual funds, maybe you're buying index funds, maybe your financial planner has you invested in certain types of stocks, maybe you have a certain risk exposure, so maybe you get a little bit better return, but if volatility hits, that better return turns into faster losses. That's the way the stock market works historically. Now, I'm going to take a look at the S&P 500 because that's what the major financial players like to use for baselines for returns in the stock market, the S&P 500. Now, the S&P 500, if you took $24,000 and you invested it in the S&P index fund 1 year ago today, you would receive a 47.6% return on your money. That's a really good return, isn't it? But you have to also understand why all of a sudden you're making 47.6% return on your money. It has to do with getting into the stock market a year ago when we were trying to decide whether or not, after the market had radically dropped because we went into coronavirus, we went into the pandemic, the market tried and did recover. It was a V-shaped recovery. It was the recovery everybody was hoping for. So if you bought in a year ago, you actually bought your stocks on sale. That's what I'll call it. I'll call it on sale. But let's talk about the returns. If you bought a year ago, would you have doubled your money? And the short answer is no. At a 47.6% return, what you're looking at is a return on investment of about $11,000. So if you were going to double that $24,000, you would need to stay in the market longer. Okay, so let's look at what a 3-year return projection looks like. 3 years, if you had invested 3 years ago in the S&P 500, your overall return would be 58.65%, meaning that when you put that money into the stock market, you would not have doubled your money after 3 years. And part of the reason that return rate is a lot closer to the 1-year return rate is because now you have a longer time horizon in the market. So when you bought in 3 years ago, the market was in a different position. It was actually, if I recall correctly, it was actually higher. Well, let me just take a look at what the chart shows me. And yeah, 3 years ago, you would actually be buying at a higher price point than what you would have bought at a year ago. Yeah, but then you go, well, wait a minute. Why would I do that? Okay, so here's the magic number. At 5 years, you get to the point of doubling your money. When we come back from the break, we're going to talk about how fast you can get it done with real estate.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. So we're taking a look at historical returns in some of the major indices out there in the stock market. And the reason I'm addressing the stock market first is because that's probably what you're comfortable with. You're probably very comfortable looking at what those indices do, or whatever your mutual funds are doing, or whatever the collection of stocks that you buy are doing, and you're analyzing the returns. Or at least you should be. See, at the end of the day, regardless of how you invest and whatever you invest in, there's really two things you need to know. You need to know what kind of returns can you get on your money. You also need to know what your risk level is. So there are stocks, there are things that you can buy in the stock market that can produce better returns than, say, this S&P 500 can return. But they come with a higher risk level, meaning that those stocks or whatever you're purchasing have more volatility, meaning the market could do something that you don't have control over. And if that price starts dropping dramatically, you may be in a world of hurt. Now, one of the things that I found was that the historical return on the S&P 500 for a 5-year period, I mean, looking back, if you had taken $24,000 and just plopped it into the S&P 500 5 years ago today, your rate of return effective today would be 100.6%, meaning in 5 years, you were able to double your money. Now, the Nasdaq has got a better track record. It really does. The 1-year return is pretty impressive at 63.22%. But keep in mind what was going on in the market a year to a year and a month ago. And that's part of the reason those returns are in my opinion, as high as they are. The 3-year return, however, came in at 101.2% return, meaning if you had taken $24,000 of your money, bought shares of the Nasdaq index, and just let it ride, you would have doubled your money after 3 years. As a matter of fact, the Nasdaq does better over 5 years. That number came in at 187.9%. So there you go. Better returns, right? All right, well, let me tell you what $24,000 can do for you for rates of return over a 3-year period and a 5-year period if you bought a piece of real estate and if you bought it correctly. So what does correctly mean? Correctly means that you're taking advantage of the 5 different ways we make money in real estate. 6 different ways, technically, if you're in pure multifamily, which is apartment communities that are 5 units or more. But I'm going to stay in the single family space. So there's a deal that actually just came out today. Now, I'm not going to go back 5 years because I don't want to. I don't want to go research the past. What I want to tell you is what can 5 years do for you in real estate? Because real estate is not as volatile as the stock market. Real estate tends to be a lot more stable. Now, does real estate have issues from time to time? Yes, it does. Yes, it does. But from my historical perspective, not nearly as bad as the stock market, and definitely not as painful as the stock market. So here's a deal that I was looking at. This thing can be bought for about $88,000. It's got some issues. This is a property that's going to need a lot of rehab. As a matter of fact, you're going to have to put about $67,000 into rehab and holding and closing costs to do this deal. So all in, you're going to need a pretty big chunk of money. You're going to need about $153,000. Now, you're not going to pay all cash because that doesn't give you great rates of return. Oh, and by the way, when you have all of your money in the deal, there's no money available when the next deal comes along and you want to grab that and get that thing staged for your next property. So we believe in not using all of our money. We believe in leveraging our properties. In other words, we go out and we find lenders that are willing to lend us money for a rate of return to help us do what we do. And what that allows us to do is to go out and buy distressed properties that most people either don't want to buy or they can't buy. And then we acquire those properties and we start to fix them up using a lender's money. We call it hard money. And whatever the lender's funds do not cover, we come in with cash. So in this particular deal, the way it all sorts out is that it would take about $24,000 for you to acquire this property that you can buy for $88,000. But now here's the thing. It has an after repair value of $168,000, meaning that like-kind properties all fixed up in that particular neighborhood where it's at are trading for about $168,000. Now, some of the returns you're going to get once you fix this property up, put it back into service, find your great resident for your property, and you start operating it efficiently and effectively, this property is going to return cash flows. And the cash flow numbers that I'm looking at are about $342 a month. When you annualize that, you're getting an income stream of about $4,100 per year. And that's just on the cash. Now, another way we're making money in this property is we are doing something called capturing equity. Now, capturing equity is a concept that people have difficulty understanding sometimes. And I don't know why. Maybe it's just because it kind of gets confusing. But let me just explain what capturing equity means. If the property has a retail value, and in this case, it's $168,000. That's that ARV that we're working with, that after repair value. And your total cost for everything, acquisition, repair, fees, whatever, comes up to 150, well, in this case, I think my number is 155,000. Yeah, because I was actually looking at the wrong math line. So it's $155,000. That's your all in. But you're still at a wholesale price because your total cost at $155,000 is below the retail price of $168,000. So you're capturing equity in that property of $13,000. That captured equity is really a very important thing. And when we come back from the break, I'm going to tell you why you really need to capture equity. Stick around.
We're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Welcome back to the show. So we were talking about some of the different rates of return that you get in real estate. I mean, there's 5 different ways we make money in real estate as opposed to the 1, maybe 2 ways you can make money in the stock market. And the other big difference is this. If you are in the stock market and you're making money that second way, which usually has to do with a cash distribution, maybe you're buying, maybe you own stocks or bonds or whatever you have in your portfolio that pays you a monthly or a quarterly dividend. Okay, that's the second way you can actually make money in stocks. We do that anyhow in real estate. If we can't make cash back on a monthly basis. In other words, if that asset is not producing streams of income for us, we don't buy that asset. If it costs too much and we wind up paying full retail price, we don't buy that asset usually. And here's why. You need to be rewarded for doing a good job. In our lane, the way we look at capturing equity, that's kind of part of the reward for finding the right distressed asset, understanding what it needs in order to bring it back to its glory days without over-improving it, putting that property back into service as a rental property for a family that is looking for quality housing, executing a lease, which is your business agreement between your resident and yourself. It talks about all the things that are expected of them. It talks about all the things that you will provide, and then you operate that property. And because you fixed that property up, you looked at everything that could go wrong in the next 5 years. You addressed it all. So your maintenance issues that could arise over the next 5 years are slim. They're slim. This helps to stabilize that property so that your rent income is not being overrun by maintenance costs. Yeah. So that's how we tend to keep very stable cash flows in our property. So equity capture, it's even more than rewarding yourself. It really is. It's instant wealth that you generate. I mean, you think about it. The property that I'm talking about today has an ARV of $168,000, meaning all fixed up in that particular neighborhood. That's what you could sell it for today, $168,000. But your all-in cost on this property to do everything is at $155,000, meaning you now command an additional $13,000 in equity in that property that you would have not technically received had you paid retail pricing. Now, some of you might argue, well, wait a minute, that doesn't make sense, Al. Hold on. Take 2 steps back. If the property is worth $168,000, what kind of mortgage do you put on it? Well, that kind of depends. You could put a mortgage on it based on the $155,000. I mean, you could do 80% loan if you wanted to do that. Or if you have the right lenders that understand what you're doing, they can give you an 80% loan at the $168,000. If you take the loan at the higher amount, it's going to reduce your cash out of pocket. Yeah, see, that's the significance here. By capturing equity, there's kind of like this inverse relationship with the cash out of pocket that you need in order to execute the deal. This is why when we go out and we buy properties, as members of Lifestyles Unlimited, we're not putting 20 to 25% of our money into the deal and we're not paying full retail because there are benefits to fixing up properties. And here's the other thing. The types of properties we're looking to fix up are workforce housing type properties. We don't get a lot of competition from people wanting to flip properties. And here's why. Flippers have a tendency to go for more expensive properties. See, they want a bigger delta between their ARV and what it's going to cost them to do the business. And if they're doing, let's say, a major flip, I mean, I was looking at an email that somebody I know sent me. They're doing this ginormous flip up in Dallas, some 4,900 square foot house. It has an ARV of, I think they said 850,000, and their all-in costs are going to be right at about 600,000. So they're thinking they're going to make a big chunk of money. And, you know, if everything holds constant and they get that property done in the next 6 months, they stand to make a big chunk of money. But here's the other thing. And here's why we don't flip. That is risky. What if the market corrects in the middle of that flip? What if property values go down in the middle of that flip? Now that flipper is scrambling to try and at least get the property finished and disposed. And meanwhile, it's blood in the water and the sharks are circling. Now let's come back to this little rental house that we're dealing with. First of all, the margins aren't majorly huge for flippers. So if they're going to spend 3 to 6 months on a property, flipping a property, they have a tendency to go for more expensive properties. That's just what I'm seeing in the market. I'm not saying that's 100% accurate. I'm just telling you that's what I'm seeing. The other thing is this. If you had to, let's say you did everything you were supposed to do, the ARV is at 168, and for whatever reason, you need to sell that property right away. Maybe something dramatic happened in your life and you need to get your $24,000 back out of that property. Well, let's do some simple math. At $168,000, if you put a for sale sign on that property at $168,000, you would get offers for fair market value. As a matter of fact, in this market, you'd probably have people bidding up the price. But let's say they didn't. Let's say it was only $168,000 and you sold it at $168,000 and your costs of sale were about 8%. That works out to be about $13,400. The equity you captured on this deal was right at the $13,000 mark. And this is why it's important, because it gives you a very short-term exit strategy just in case you need to get out of the deal. And you're not going to lose money in the process. Okay, based on my math there, maybe you lost $400. But you will have preserved your capital. And that, to me, is the most compelling reason why you need to buy properties at wholesale prices and fix them up and keep that pricing at wholesale pricing. Because you need to have that delta between what you've actually got into that deal and what you can sell it for available to you, unless you've got to get out of that deal very quickly. What are the odds you're going to get out of that deal very quickly? Slim and none. Let's say somebody you know gets injured and you've got massive hospital bills coming up right now. I mean, came out of the blue. You didn't know it was coming. You got like $20,000 in the hospital bills. Boom, right there on your desk. Well, this I know. You could sell that asset, not lose any money on that asset, turn around and pay those medical bills. Now, I'm not suggesting you should tap into your investment capital to pay things like medical bills and stuff like that. But then again, most of our medical bills don't go from $0 to $20,000 in a matter of an accident. So it gives you a contingency plan if you need that contingency plan. But here's the thing. When you buy that asset, you're going to hold that asset and you're going to operate that asset for a set period of time. We come back from the break, I'm going to bring this all around back to square one and give you the answers you're still looking for.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the show. So if you had taken $24,000 and you put it into the S&P 500 5 years ago, the rate of return that the S&P 500 returned effective today for the past 5 years is right at 100.6%, meaning it took 5 years for your money to double. And you didn't do anything along the way. You just put that money in, kind of forgot about it. 5 years later, you doubled your money. Now, if you'd put your money into the Nasdaq, you wouldn't have needed the whole 5 years. You could have doubled your money in as little as 3 years, because the 3-year return on the Nasdaq is 101.2%. As a matter of fact, if you'd taken that money and just dropped it in there and let it ride for the full 5 years, you'd be looking at 188.9%. Let's just call it 188% just to keep it simple. Meaning that $24,000 that you put into that investment, essentially what would happen is that $24,000 should go up to about $69,000. $69,120 is what my math came out to be. It's not a bad return, right, for a 5-year hold, knowing that you doubled the money at the 3-year hold, right? Let's talk about what happens when you buy the real estate asset, because the real estate asset is designed to pay you 5 different ways. The standalone income stream is the cash-on-cash returns. In other words, the residual income or the passive income that comes in based on the fact that you're renting the property out, you're covering all the associated expenses, and whatever is left over is your money to use for whatever you want. And in this particular deal, I'm estimating it to be $342 a month. Annualized, that works out to be about $4,100 per year. Based on a $24,000 investment in this property, you're getting a 17% cash-on-cash return every year. You're also capturing equity in this property of $13,000. And that equity capture is important because it is the baseline of additional equities that you're going to get as you continue to operate this property. Because this property is going to start off at $168,000. That's the fair market value. And real estate tends to double in pricing every 20 years. So what I will do is I will sit down and I'll say, okay, 3.5% is a realistic number. And I will do projections based on my property going up 3.5%. So at the end of 3 years, I could anticipate appreciation of $18,265. If I hold it for 5 years, I would look at about $31,531. So at that 5-year mark, that $31,000 exceeds the $24,000 that I put into it. So just on equity growth over time, just doing what the markets normally do, I will more than double that money. Let's tie it all together because you're also getting principal pay down. Yeah, in other words, every month when you make that mortgage payment, some of that is going to reduce the principal that you owe on that property. It's not a huge amount, but it occurs month after month after month. So let me give you the long-term numbers. And let's do compare and contrast. So I said the Nasdaq could double your money in 3 years. So let's say we just held this property for a 3-year hold, looking forward 3 years. Here's what your returns would be. If you sold that property at the end of 3 years, your adjusted capital gains, this is after paying closing costs of sale, would be a little over $58,000. And then when you add in the over $12,000 in cash flow that was produced by that property, which you can spend on anything that you want. That's money that's available to you every month. When you calculate that in, you now have an adjusted capital gain of about $70,500. So without including the cash flow, you're at 142% return on investment at 3 years. When you calculate in the cash flow that you received after 3 years, that number jumps to 193%. Seems to me 193% is a better number at a 3-year mark than 101.2% that the Nasdaq performed at. You see where I'm going here? As a matter of fact, your break-even point, in other words, if you were just trying to double your money, you could probably dispose of this property right around the 2-year mark. Now, I didn't run those finite numbers, but after a 2-year hold, you could safely say that you would have doubled your money. Let's say you hold it the whole 5 years. I mean, after all, the Nasdaq did what, 188% on a 5-year hold? What does this property do if you hold it for 5 years? You're looking at an adjusted capital gain. This is after you sell the property, you pay all associated closing costs of $77,275. When you add in the $20,500 of cash flow that property will have produced over 5 years, you're at $97,795. Okay, let's call it $98,000. So essentially what you did was you took $24,000 and over a 5-year time horizon, you turned it into $97,795. So your rate of return is actually 307.48% versus what your money would have done in the Nasdaq at 188%. This is what I've got to get you to wrap your head around, because the fact that you're putting your money to work in an asset that is working for you. I mean, come on, let's get to the brass tacks of this. When you buy this asset, you're not camped out on the lawn 24/7. You might drive by it. You might have a contractor drive by it and FaceTime you or however you do business. You may not even step foot on this property. Yet, when you're properly educated on how to locate properties, how to evaluate properties, how to make determination as to whether or not a property will be a good addition to your portfolio, these are the important things that you need to know. And when you've got the whole big picture together, where it just becomes a fluid motion for you, it's kind of like riding a bike. Remember the first time you tried to ride a bike? How many times did you fall off that darn bike? Even with the training wheels, right? Yeah. But then at a certain point, you were able to ride with the training wheels. And then at a certain point, they were able to raise those training wheels up, right? And to a point where you didn't need them. And you said, Dad, take the training wheels off. And you never looked back from there, right? Well, that's kind of like what it is like to become a member of Lifestyles Unlimited. See, you're going to get all the education and training that you need in order to do what I've just kind of talked to you about, to analyze deals, to determine whether or not, do I take $24,000, do I drop it into the stock market and hopefully get 188% return on investment over the next 5 years? Or do I take $24,000, do I correctly buy a piece of real estate that will allow me to grow my money over the 5 years to, say, 307% return on investment? Now, here's the other thing. If you sold the stocks at the end of the 5-year period, you're subject to capital gains tax. So you probably ought to take a look at what tax bracket you're in based on your hold time and based on your income levels. But those of us that do real estate, not only is the income from the cash flow tax deferred because of the depreciation write-offs that we take on the property, when we go to sell that property and we calculate what the capital gains are and the depreciation recapture taxes are, we can just do a 1031 exchange and move that tax liability into other property. So we get the full benefit of all of the cash coming out of that deal without having to pay taxes associated with transacting that property, which, when you take into consideration tax implications, real estate numbers are way better than stock market numbers. Oh, by the way, you don't have to worry about waking up and going, oh my gosh, there's a sell-off in the market. If you want to find out how we do this, go to freeworkshop.livestream.com. And remember, it's not the money, it's the lifestyle.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.